Okay, we're going to go ahead and get started. My name is Lorraine Gilbert, CEO of WealthWise Financial, and this is our mid-year outlook call that we have today. And we do a webinar series every month with various educational opportunities for our clients to listen to. So thank you to everybody who's on this call. Today, we're very pleased to have with us an economist from John Hancock Investments. And so in just a moment, we're going to hear from John Hancock on their outlook, their mid-year outlook. Before we get started with that, I've asked John Milligan in my office to give us an overview right now because we have just started earnings season. And this week is an exciting week because it's tech week. So we have a lot of earnings from tech. So with that, John, I'm going to allow you to go ahead and do a brief overview of what we're seeing right now in earnings season.
Absolutely. And thank you so much, Lorraine. So we'll look back at what we've had reported so far for calendar quarter two. We have approximately 20% of the S&P 500 having reported, with 75% having reported earnings per share above expectations, relatively in line with the 5 and 10-year averages. Compared this quarter to the quarter Q2 in 2022, earnings are down year over year in the high single digits. And if this continues, it'll mark the third consecutive quarter of year over year earnings decline. The year over year decline is slightly worse than previously expected at the beginning of the quarter due to some dramatic misses from a few large insurance companies. But our expectations is that it will continue to improve throughout the reporting period as more companies share results. Last week, Tesla reported a fairly good earnings beat, but the stock had a subsequent decline near 10%. We believe this is largely due to margin expectations. The margins have been declining as the company has had to cut prices, and the market was looking for some guidance from management, and Elon did give an indication that they might have to compress even further if the market were to soften. This week is the tech week, so we'll go from about 20% currently of S&P 500 companies have reported to over 50%. We get big names this week, such as Microsoft and Google, but we also get a lot of other exciting information from companies like PacWest, who have been embroiled in a lot of the issues with regional banking. We get information from companies like NextEra Energy, NXP Semiconductors, et cetera. So this will be probably the most exciting week for earnings. And at the end of the week, we should have more insight into how things are going in the economy in general.
Thank you, John, for that overview. And just to remind people that as far as John Tesla, we bought Tesla, though, at a low. So even though it's down, what you just said, 10% yesterday, we're up 100 and what was that when we bought Tesla? How much have we gained in Tesla?
Oh, it's over 100% from the last purchase. We made a purchase at the end of December. We saw Tesla as a few things. One, liking the long term for the company, but also we're under the belief that there was just a lot of loss recognition in the stock. People had been selling a lot of it towards the end of the year to recognize losses. But yeah, we have had some pretty strong growth there. And the stock is up over 3% today, a little bit of a bounce back from going down last week.
Perfect. Okay, thanks for that overview. Now, I'd also like to mention Carissa, who's on the line. Chris is our paraplanner, and all of our clients, you talk to her all the time. And so thank you, Carissa, for setting all of this up and helping us with the webinar. And now I want to introduce Travis Klein. So Travis is our representative with John Hancock Investments. He is our regional vice president for John Hancock, and he has been working with us for a number of years, I think since 2016 or so. And so when Travis offered us to have Francis, an economist for John Hancock, speak, we jumped right on that. So Travis, thank you so much for bringing Francis in, and I'm going to turn it over to you to make that introduction.
Yeah, thank you so much, Lorraine. Really appreciate you having myself and Francis, John Hancock Investment Management, on the call today. I'm very excited to introduce Francis and have the opportunity to hear her speak. So for everybody on the call to get a better understanding of what Francis does on a day-to-day basis, I think it's really important that everybody understands who we are as an asset manager first and foremost. So we're managing about $1 trillion around the world. We're the 8th largest insurance company in the world. Many of you probably recognize the John Hancock brand. That's who we fly our flag under here in the United States. In over 20 different countries around the world, we actually operate under the Manulife brand and flag. So in Francis's background, some of the slides there, you may see the name Manulife. Just know that that's one and the same in terms of John Hancock Manulife. And so Francis is actually our global chief economist. So she is on a day-to-day basis, looking at the world, trying to get a better feel for what are these asset class returns going to look like in the next 3 years, 5 years. And she's actually driving a lot of the asset allocation decisions that we make in all of our target date funds. So if you think about our 401k platform, again, one of the largest 401k providers, all of our target date strategies, she's going to be involved with those discussions in terms of deciding, hey, are we going to overweight, U.S. equities or international or fixed income? What does that look like? And Francis has a pretty impressive background and pedigree. She got her undergrad in economics from Queen's University. She then worked for the Central Bank of Canada. She paused that and went back to school, got her master's from NYU in economics as well. At the age of 33, she was actually named the youngest chief economist in all of Canada. In that same year, was actually named to Canada's top 100 most important women. So we're very excited to have Francis here today, and I'm going to kick it over to her. She's going to share some insight on what the global economy looks like for the next 1, 3, 5 years.
And
Thank
Travis,
you again, Francis.
Thank you so much, Travis. And before Francis gets started, I just also want to mention that she is on the East Coast. And Francis, we really appreciate you being here at this time because I recognize it's late for you. So thank you so much. We look forward to hearing your presentation.
Honestly, I was just pretty excited that I got to tell my husband that I would not be doing any dinners or bedtimes with the children and that I was going to enjoy myself with some fellow finance and econ aficionados. So I feel like you did me a favor with this, Lorraine. It's my absolute pleasure to be here. I was thinking about what I might talk about today. And it's such a pleasure to be able to speak to, not fellow portfolio managers, which is my day-to-day, and it's a pleasure to speak with advisors, but actually for those who are sitting at home, turning on the television and trying to figure out what the heck is going on. And you'd be surprised if I said, what do you think the most common question I get would be? I think a lot of portfolio managers would say, people are going to ask you about, is there a recession or no recession? Or, is inflation going to decline or not decline? What's happening with government spending? But actually, the most common question that I get is a different one. It is one that I've never received in my career. The question I get almost every day from all types of people who watch the economy is, Francis, how come every time I turn on the TV or I read something, there are so many economists and strategists across the world who all have access to the exact same information and yet see it all completely differently? How can everybody look at the same data point and believe in a different outcome? Why is it that half the economists are calling for a recession and half are saying there's no recession at all? Aren't we all looking at the same thing? How come some say we're going to go back to 2% inflation and central banks are going to cut next year, and others say no, interest rates are going to stay high and may go even higher than we expect? So I thought what I might do today is just peel back the curtain a little bit with this group that I don't get to speak with that often. And I want to show you a little bit about how the magic is done. I want to reveal to you the trick. And I hope in doing so, I can demonstrate how many people are looking at the same data points and coming to a different conclusion. I think I also hope to convince you actually to maybe listen a little bit less to economists in the next year, to look at more seasoned financial professionals who are thinking about the long run and not just what's going to happen next month, and why we maybe need to rethink a lot of the ways that we've conducted economic outlooks compared to what many of us would have learned if you suffered through an Econ 101 textbook. So to do that, I'm going to start with what I normally would have presented. In the past, I normally would have started a presentation with like this by saying, well, here's our standard economic outlook. And I would have showed you these super boring charts. These are charts showing our forecast for what happens to US growth. You can see this black line here to differentiates between what's happened in the past and where we're going next. This is US GDP. What is GDP measuring? I could give you the textbook answer, but really we're just looking at growth. And you can see in my standard textbook basic model forecast, I've got 2 quarters here of negative growth in the United States. That's the next quarter, Q3. Actually, we're in it right now. We've been in it for 24 days. And another quarter of negative growth in the second half of 2023. And then a nice little bounce back. We're back to growing towards 1-2% by the end of 2024. This is what one might call a shallow recession or a garden variety recession, terms that you've probably heard before. And at the same time, we would look at inflation. Now, many people look at headline inflation. That's all the components that go into this mathematical video game we call consumer price index. And certainly many of you may feel that this index does not represent your reality. In fact, it probably doesn't, because it's an average over a large swath of Americans. And we generally see, based on our boring standard models, that inflation is going to head back to 2% by the end of next year. So that's about 18 months from now. Now, one of the reasons that standard economic models are telling us that this is the outlook, and just about anyone who uses an economic model is certainly going to be looking at an outlook that looks very similar to this. There are many large banks that I know of that use a very similar economic model to us, and their model is going to say a 2-quarter recession and a bounce back and inflation back to 2%. The reason for that is almost all economic models are built effectively the same way. They effectively all look back over a period of time, usually back to the 1980s. Some go a little bit farther. And they say, when one event happened or one data point behaved in this way, this outcome occurred more likely than not. That's effectively what it's doing. It's just like when my mother feeds my son an ice cream sandwich for lunch and then a popsicle for snack and then gets cake for dessert. More likely than not, we're not going to bed early and there's going to be some sort of nervous breakdown by 8 p.m., right? Not always, but most likely, yes. That's all an economic model is doing. So a lot of economists right now, we're looking at the standard indicators that historically have led to a decline in growth. And economists are really fascinated by the concept of what indicators tell us what the future holds versus which ones tell us what's behind us. And there's a lot of standard economic indicators that are really good at telling us where we're going to be in 6 months. We call those leading. And I'm going to tell you, you can look at this chart here, just about every major indicator that has historically told us there is a recession within 3 to 6 months is flashing red. Some of these are flashing excessively red. And if this was a regular economics presentation, I would then try to convince you of this recession by showing you all these indicators one by one, and it would be rather dull. Sometimes people say to me, but Francis, the unemployment rate is so low, the labor market is so tight, how could we be heading into a recession? Well, you can see here, usually the job market is the last to turn heading into a recession. It's the last thing to break. So we don't look at that as a leading indicator that tells us where things are heading next. So typically, this would be the bulk of this presentation, and this would be what I would go on TV and talk about. I'm heading down to New York tomorrow. I've got 7 interviews, and I wish that it was easy, because if it was just 7 interviews of the standard economic outlook, I'd just print out this sheet and go along with it. And yet I have to tell you that when I look at my standard economic model and I look at what the forecast tells me and I look at the traditional relationships between, when manufacturing declined, it bled into services, something doesn't quite sit right with me. Something feels like there are different things happening that maybe my model, which only looks backwards, isn't quite capturing. And one of the things that keeps me up is a really simple chart and story. It might be the simplest chart that I could show you. It's the US 10-year yield, the yield that you get on the US 10-year Treasury. This is one of the most liquid and traded financial instruments in the world, if not the, and it actually is the one that provides us the most amount of information about what's happening in the financial community. Excuse me. And you can see, and I don't want to date myself too much, but for my entire life, as long as I've been alive, US 10-year yield, all yields and all interest rates have been on a downtrend. They have been, of course, fluctuating, but if you were to draw what technical analysts would refer to as a corridor, we call it pulling our crayons out, you would see that this downtrend has not been broken since effectively I was a sparkle in my mother's eye. And so we've all become very accustomed to this environment in which, yes, there's ups and downs, but interest rates decline and fixed income does well over this period. And, credit gets cheaper. There's a lot of reasons that this happened. It happened because, well, we were in a low inflation environment. And that low inflation environment was driven by demographics. People just don't have babies anymore. Well, I do, but I'm finished now. I'm exhausted. Globalization. Globalization made everything much cheaper. So if you wanted to buy a television now, it is substantially cheaper than it would have been for you 20 years from ago. We've got a larger share of government that's part of our environment, and we have digitalization. Just the ability to access information for free has become powerfully deflationary. It's put interest rates very, very low. The other day I was driving on the highway with my husband, and the tire popped on the side of the highway, and we were a ways out from home. We're like an hour from home. We didn't have the kids. I started to panic because, oh my gosh, I can't remember if I, signed up for AAA again. Who are we going to call? I don't know what to do here. And then my husband said, oh, you know what? I think I'm just we're going to spare. I think I'll just watch a YouTube video. I'm pretty sure I remember how to change the tire. And he sat on the road and he watched a YouTube video and changed the tire. So the first thing I got to tell you, I have never been more attracted to my husband in my entire life. That was some real manly taking care of me, I got to tell you. And the second thing is that it was powerfully deflationary. It was an excellent example of access to information that is free, that lowers the costs of things. And this is the type of thing that innovation has created. On this chart, you can see that while we may not have convincingly broken out of this downward trend, it does appear as though this downward move, this race towards zero, may be reversing course. And if that's true, then we may be entering a new financial paradigm, one that for the past 40 so years has not existed, and one that may somewhat negate or at least call into question some of the standard ways that we look at the economy, or ways that we have traditionally learned about economic relationships. And so when I come into work every day, we of course start with our base case because you can't throw it all out, but we ask ourselves a really important question. Is it time to rethink? Should we be using the standard operating model? Or what things are happening in this economy that maybe mean the standard economic model doesn't quite work or works differently? And if indeed we have to throw out the old economic models, how do we construct a new forecast? So the first reason that I am concerned that the way that we're thinking about the world may need a different approach, and in this case, it's much more positive. I'm sure many of you have experienced a very substantial, in fact, one of the worst we've ever seen, labor shortages. I've spent a lot of time in airports in the last 2 months. I don't think I have had a single flight leave on time. Many have been canceled, and these were largely due to labor shortages. And I know everybody feels that in their own environment as well. Just to give you an example of how severe this labor market environment is, did you know that 40% of Americans don't work? 40% of those over the age of 18 do not work. The employment to population ratio in the United States is 60. Why is that? A lot of it's demographics. We actually have the highest share of Americans over the age of 65 that we've ever seen in modern economic history. A lot of it is those on disability. You know, the number one reason people were on disability in the 1960s, that was heart disease. Today, it is back pain. Back pain, the number one reason. Now, I'm not saying that people don't have real back pain, but I do feel like it's maybe a little bit easier to fudge than heart disease. I don't know. So that's one thing. There's certainly some people who cannot do work because of back pain. Incarceration rates are extraordinarily high in the United States, about 1 in 100 Americans, depending on where you are. And this is contributing to just a sheer amount of people available to work being substantially lower. So right now, for every job opening in the United States, there's less than one unemployed person looking for work. There's 0.6 of a person. So if you have a job opening, you don't even have one person on the sidelines. And in standard recessions, or indeed even in good times, you'd have at least 1.5 to 2 people unemployed per job opening. So at least if you're applying for a job, you had one other person with whom you were in competition. But instead of 1 to 2 people being available for job opening, now it's the reverse. Every unemployed person has 2 or more jobs available to them, depending on their skill set. So in the short run, this is certainly a negative. It's giving labor, well, it's negative for the economy in the sense that it gives labor a lot more power. As an aside, if I was speaking on a different topic, I might say this is an important reset after a generation of labor not having sufficient power and not seeing wages increased across the income spectrum to the same degree. So this is contributing to a lot of power going toward the labor share of the economy and wage growth being higher than it has in the past, and even union activity being substantially higher. But from a recession point of view, and why I'm concerned that I might be breaking my models, is that historically, as the economy starts to slow and companies have higher interest rates, they look for ways to decrease costs. And one of the ways they've decreased costs in the past is by shutting down headcounts. But if you look at a lot of survey data lately, a lot of companies have indicated in surveys that they are not going to be shutting down headcounts. They're going to be doing something different. They're actually going to be reducing the amount of hours that their employees work. But that's actually a better strategy in a world where rehiring is very difficult. So if we are going to a garden variety recession and it took people 1 year to 2 years to staff up their restaurant or their store or their ski hill or any of these things, then most companies are saying, we're not going to fire people because it's going to take us years to get them back. We're just going to cut their hours. And actually, when you look at average hours worked in the United States, those are back to pre-COVID levels, and each month they decline. So my theory that actually the unemployment rate is going to stay low and people are not going to lose their job, they'll just be working less, is increasingly coming to fruition. That means that the unemployment rate, well, that's probably not going to move in the same way that it has in past recessions. And because of unemployment itself, if you've ever experienced it or someone close to you, you know that that is a massive, massive consumer shock as well as financial shock. We're probably not going to see that to the same degree in this coming recession. Now, there's another thing that's happening, which is dampening our model's ability to predict the future, and that is that typically what would happen is that in an environment where interest rates were rising and costs became more expensive, we'd actually see a pullback in the US consumer. This is not happening. Retail sales in the United States are very strong. Consumer confidence is back on the upswing and people are feeling good. And the reason is probably that there is still a massive amount of stimulus in the system from 2020 stimulus checks. There are a lot of different ways that you can estimate this. Our estimate is about $1.54 trillion still in the system from stimulus checks. The Federal Reserve has done a different estimate. They say it's closer to zero. Others say it's actually double what we've estimated. Goldman Sachs is around $1 trillion. No one really knows how to calculate what exactly excess savings are because, well, are you supposed to look at what savings were in 2019? Are you supposed to look at the trend? How do you really get away with this? But what's clear is that the consumer still had a lot of excess padding relative to past recessions, so they've been able to absorb a lot. One of the reasons that I'm not negating or throwing out the recession call completely is because you can see the downtrend in these excess savings. And no matter what metric you're using, all of the metrics suggest that, well, there's going to be a limited time in which those excess savings provide comfort. Perhaps more importantly, a lot of excess savings in the United States are in high income Americans, not lower income Americans. And higher income Americans, well, they tend to save when they have extra cash on hand. They don't go out and spend it to the same degree. So excess savings is a game changer. It means that the standard relationship between the decline in manufacturing and unemployment and the drop in consumer spending is not happening as quickly as it has in the past. So some of you might hear about this concept of, well, the recession keeps getting pushed out, therefore it must not happen. I think this is one of the reasons why that recession call keeps getting pulled back. Once again, this is a positive. This means that the recession call might actually be too negative an outlook in this type of economy. Let's talk a little bit about the inflation side of the picture and why I'm also worried about the inflation elements. Now, while I think maybe the risk to my recession call is that it doesn't happen or it's a little bit lighter, one of the things I spend a lot of time thinking about is inflation. And is my model that says inflation is going to go back to 2%, is that accurate? Or are there things that are happening that are maybe different than what we learned about in our textbooks? Now, up until about 2016, going back to the 1970s, and we even have data going back farther than that to the 1930s, we know that globalization and the deflationary impact of doing trade with the world that decreased costs was a powerful deflationary force. It meant that companies could go and find the lowest cost producer of intermediary goods and labor around the world, and that this actually decreased costs for all of us at home, particularly in the goods area. So TVs, fitness equipment, commodities, anything that's you could drop on your foot that hurts, that is a good, effectively. And yet, starting in about 2014, 2015, and especially in 2016, with President Trump's election and the Brexit outcome, we began to see a really important inflection point in this story. And many economists and politicians called into question the idea of, well, maybe globalization, while it decreased the cost of some goods, wasn't the ultimate best economic outcome. Now, for a lot of economists, this is a difficult thing to swallow because I think I went through tests and tests and tests where I learned if there's two islands, there's a comparative advantage to them just focusing on their own good and trading it between them. I think we all went through that exercise. Global trade is good. There's no way around it. The math always works in your favor. But certainly there is a growing amount of the general public, of policymakers who are questioning whether that may not be true. Regardless of whether it's true or not, we have now seen a change where doing business with the rest of the world is becoming in part more expensive. Some of that is by design, tariffs. Some of that is because of other factors that have happened. COVID resulted in massive disruptions to our supply chains. We all know this. Now, I don't want to buy anything that isn't built 10 miles from me because it's going to take forever to get here and it may never get here. We all know this feeling, right? I remember being in slightly after COVID when the world started to open up, going to LA and seeing the ships just lined up like Lego bricks all the way out, just waiting to be able to come and unload. It was one of the most shocking economic scenes that I have ever seen. And just spending a lot of time reading about LA ports. You know, you think you're going to do something in your life and then you find out you spend time looking at days at port data. That was something I never thought I would do. So effectively, a lot of American businesses experienced two shocks. One was tariffs and two was supply chain disruptions. And over that time, a lot of companies began to say, you know what, even if something is technically lower cost abroad, for us, it's actually worth it to pay a little bit more to have it manufactured at home because it's almost like an insurance policy. We know that we can't get disrupted. We know we're not going to have tariffs applied. We know that ports are not suddenly going to shut down if there is a new pandemic or what have you. So this is actually contributing to a lot of ways that we measure globalization as shifting. Is it deglobalization? I'm not sure. It might be slower globalization, but it is a shift in the way that we think about prices. Now, at the same time as we talk about the shift in the way that people are doing businesses and a little bit of a revolt against globalization, we're also experiencing a variety of other supply side problems. One of the big ones is that there is an ongoing war between Russia and Ukraine, which has shut out about 1/3 of wheat production that's occurring globally. We just don't have access to it. And every day I come in and there's a new headline about Russia, Ukraine, and all I see is agricultural prices going higher over this period. Food prices going higher. We've had a long list of weather events that have occurred across the globe. Latin America has had droughts. We had our first tornado here. I'm in Montreal, never had a tornado ever in my life or my parents' life. Ripped the trees right out of the ground. We don't even have a basement. I had no idea what to do. We went and huddled in the bathroom. And also, some of you may have heard about massive wildfires. Wildfires that are just decimating the East Coast with smog and smoke. And yes, you can blame Canada because most of those wildfires have happened here. But of course, they've decimated lumber. So one of the problems is that if we start thinking about prices, in the past, if a central bank wanted to cool how much prices were in the system or how much inflation was in the system, they would start increasing interest rates. They'd effectively make us all poorer, things would be more expensive, we'd buy less. And that's because most of the inflation in the system came from you and me and Laureen all going out and buying too much stuff, going to too many restaurants, going out buying, Laureen, I don't want to ascribe to you what you may or may not be buying. Could be art. I can see that behind you. Could be books. We were buying too much of it. So in order to slow down the amount of consumption in the economy, we would actually bring down demand to meet sort of supply and bring up supply. What really concerns me about this new paradigm and where we're heading next is that the inflation that exists in this system, while some of it is definitely coming from a lot of those stimulus checks and demand and a lot more money in the system, a good chunk of it is coming from sources that we haven't seen before. Tariffs, the slowdown in globalization, conflicts that are reducing our access to the bread baskets. And then in addition to that, massive weather systems that are disrupting our access to a lot of commodities. And why this worries me is because we're still acting as though higher interest rates are going to solve inflation for us. And my model still says, well, if you hike interest rates, inflation will come back down to 2%. Central bankers themselves are saying, we're just going to keep hiking interest rates because we can and we will defeat inflation. Well, you can't and you won't combat this type of inflation. Because I got to tell you, Putin and Russia does not care at all if Chair Powell hikes rates another 25 basis points or not. And the wildfires that were sort of decimating a huge segment of North America don't care about interest rates. The droughts in Latin America are not disrupted by monetary policy. This new type of inflation in the system is very, very difficult for central bankers to tackle. And yet a lot of the way that economists will talk about this is that, well, they continue to hike interest rates in order to solve a problem that, frankly, they can't solve. In part, this is going to create more pain on the economy than it needs to without solving the underlying problem. And that's why the forecast that really keeps me up at night is, what do central bankers do next? There is a Fed meeting on Wednesday. The Federal Reserve will probably hike interest rates again by 25 basis points. This is already in the bond market. The bond market knows this is going to happen. It's been well telegraphed. That's not the story. The story is, what are we going to learn on Wednesday about what the Federal Reserve does after this? Now, if this was my standard economic outlook, I would simply say, well, the average time between the last hike and the first cut is actually 8 months. So it feels pretty good to just start penciling in rate cuts probably by early 2024. That's consistent with the rest of that recession has come. Central banks are going to respond to it. And I'll tell you that as an asset manager, when I first started looking at recession risk about a year ago, we started to see it pop up on our dashboards. I thought, this is very painful for the economy, but I know what to tell everybody to do. I know that in a standard recession, you actually can seize on a lot of really important opportunities. That about halfway through the recession, we tend to see equity markets start to rally really aggressively, and people have made their careers off of being able to take those opportunities. Even when things seem dire, we know that there's opportunities that come with us. We know that right now, if you're looking at the opportunities in the fixed income space or you're thinking about bonds, the upside available to you is substantially more than if we were in the middle of the cycle. So recessions, very painful for the economy, but tend to be good times to really have a smart financial advisor and planner walking along with you to help you understand the opportunities that are presented by it. But one thing we have to be cognizant of is this central bank, as it faces recession risk, is going to be thinking about inflation. And it's probably going to be worried that inflation is not back at 2%, even when it's naturally time to start cutting interest rates. So part of me is worried that actually the bar to lower interest rates might be higher than it has been in the past. In addition to the shifting nature of inflation, I think I can say something that all of us here have really felt, which is that we've just experienced one of the largest price level shocks that we have experienced in our lives. I'm going to walk you through what that means. Most of you will hear inflation quoted in year-over-year terms. So 2% year over year. That means that if something costs $100 this year, next year it costs $102. Most central banks operate with a bygones are bygones policy. So if you were at 3% inflation for 1 year, the next year you still target 2%. You just constantly come back to 2%. But I'm going to show you what this pink line here on this chart did over the course of COVID. This pink line here, you can see starting in 2020, experienced a huge move upwards, almost 20% in 2 years of the level that went higher. Effectively, the way you can think about that is if you bought $100 worth of groceries in 2019, it now costs you $120 for that same basket. And if we return to 2% inflation, which everyone is talking about as being the most amazing thing that could happen, prices aren't going back to 100. They're going to 122. And this is what I feel most people don't recognize about what we've just experienced. That even if we go back to 2% inflation, even here you can see the green line is 1% inflation, or this half pink line on the forecast is 0.5% inflation, prices will still keep climbing from their current level. We are not going backwards, except with some very unique things. Like all the fitness equipment that I bought over COVID that I never use, I'm selling that at 20% on Facebook Marketplace. I just want to get it out of here so I don't feel so bad about myself. That kind of stuff you'll see deflation. But most people in America are not going to see prices go back. They're just going to climb from this level more slowly. And this I do not feel has really penetrated the American psyche. I genuinely feel that this big price level shock that we experienced is almost a generational type of economic trauma that will carry with us for a very long time. I remember when I started my career, I would have, a lot of older males would like to tell me about how I wasn't there. And if I was only around in the 70s, I would totally understand. I would know that the bond market's always right and inflation go high. And I used to just get peppered with this, you weren't there comments. So I'm really excited to be 65 and have the young kids come in and say, you weren't there in 2020. You don't know what 9-10% inflation looks like. That's the only thing I can carry on in my back pocket. So these are things that I feel are not well represented in standard economic models. And most economists, when they talk about, inflation going back to 2% and the central bank saying, okay, inflation's at 2%, we can begin to cut now, are not internalizing this huge price level change that we experienced. And generally, as someone who tries to think about what the everyday household experience with the economy is, I believe that economists have not really internalized just how powerful this level change has been over time.
Francis, one comment on here I just want to make, and that is that you can see for a decade, we had virtually no inflation. And so it all caught up to us in a very condensed period of time. But if you equalize that, it really ends up being about a 2% per year inflation rate if we had done it all along. So we were
Exactly.
at very suppressed or repressed inflation numbers for so long, and then boom, it hit us. And to your point, now, but that's a point that I've made with our clients in the past.
Doesn't surprise me, Lorraine. I feel like you're often one step ahead of me. So that's a great one to recognize. So let's talk about two other quick things that I think are maybe a little bit different. And then I'm going to wrap up with some of the conclusions that I feel you can come to as an investor, as an advisor, even as an asset allocator who works with portfolio managers. So there's two other questions that I think are relevant to this discussion. And one of them has a lot to do with AI. I think probably I'd be surprised if not a majority of those of you today have maybe tried some ChatGPT, tried to figure out how it works. Is it interesting? I thought Twitter has now changed to X or something in the last 24 hours, these types of things. There's a huge AI boom that appears to be happening. And for economists, this is a really big deal because it could mean that we could see higher productivity. Productivity is effectively how much output do we get per person. For a long time, I have used this example of how an economy works I did a TED Talk about it. It's actually like the worst watched TED Talk of all time, probably because I chose to talk about economic models. That wasn't really a great choice that I made at the time. But if you have a young woman in your life and you kind of want to encourage her to think about finance or economics, check out this TED Talk. It's called The Everyday Economist. Just a little plug so I can double my numbers in one night. It's designed for the young person who maybe feels excluded or doesn't feel like finance is accessible to them. So you can take a look at that. But in that TED Talk, I talk about how we can simplify the concept of an economy down to a McDonald's. And the growth of the McDonald's, or the GDP of the McDonald's, is really simply how many hamburgers does it produce. And the amount of hamburgers that a McDonald's produces is always a function of two things. The first is how many people work behind the counter. That's your labor force. And the second is how fast each person makes a hamburger. That's productivity. And pretty much for every economy in the world, every data point you look at is going to bring you back to one of those two things. How many people are available to work? We've already covered that that's very low in the United States. And how fast can each one of them make a hamburger? Now, US productivity growth has actually been pretty bland, especially since the year 2000. And you might think, how is that possible? You know, there's been so much tech. We've had, there's Uber Eats now. How could we really go and not see these huge productivity boons? And it largely comes down to the fact that most of the productivity that we've seen has accrued in our personal life and not the productive side of the economy. So Uber Eats doesn't help me be a better worker, although I like to think that it does when I'm having a bad day. But the actual ability for the economy to generate more per person has been low. Some of that has also been the offshoring and manufacturing activity, because manufacturing was considered a very high productivity environment. One of the reasons that AI is very important to economists right now is that when we look at, on the right-hand side, our potential growth, what we can see is that, well, we used to grow on 4 to 4.5%. That was what was very common in the 70s, 80s, and 90s. This fewer people available and this bad productivity growth is actually contributing to our economy's ability to really grow closer to 2% and below. The forecasts I have on this screen don't incorporate AI. They're not in anyone's models right now because we're trying to figure out what they're going to be used for and what they're done for. But if AI really is transformative, and I spend a lot of time thinking about this, then all of a sudden, even if we have fewer people working behind the counters, they can make more metaphorical hamburgers. And if they can, then my productivity numbers go up, and then this blue line on the right-hand side goes up too. If that happens, then actually our economy can generate more jobs, it can generate stronger growth, it has the ability to actually create and more businesses and enterprises, and it means that it can stand higher interest rates than it has in the past. So this AI question, yeah, it's lifting, NASDAQ. It's very important to the breadth of the S&P. It's created a rally that I think is really important for us, and many is captured, but it extends beyond that. It basically could change the way that we calculate growth and could lead us to a new environment. So what does this all mean? Why do I talk about all of these environments? And I know maybe Lorraine said, Francis, come tell us what's going to happen to the economy. And instead I said, I don't know what's going to happen to the economy, and here's all the reasons why. But I think sometimes, and I am paid by Manulife and John Hancock to tell everybody what's going to happen. That's my job. I'll tell them what's going to happen and where they should be invested. So to say that I don't know, I cannot stress enough how difficult it is for me to do that. How it makes me feel kind of sick to my stomach to admit that the very basics of my job, I'm not sure that I can do them to the same degree that everybody wants. But sometimes acknowledging this uncertainty, recognizing the uncertainty, and saying, I need a game plan for uncertainty is the right thing to do. Sometimes it's actually the best investment decision that you can make, even if it doesn't sound so good. And then, you can't go on Fox News and just, start talking about how you're sure there's going to be a recession and there's no risk to your call. But as an investment professional who has to sit next to portfolio managers, and if I'm wrong, really look them in the eye and hear about the damage that causes, I think now is a moment where we should admit that a lot of our standard practices are not working the same way. So what do you do? Well, I'll tell you what I tell portfolio managers to do. The first thing I tell them to do is create scenarios, not just this is my view of what's going to happen for sure, and there's no way around it. We talk about different scenarios. Here's an illustration of this, for example. We talk about, a standard recession. We say that's about 50% of our outlook. We talk about how we may be in an environment we call it stagflation, where actually growth is really slow, but inflation is higher for some of the reasons we talk about, and central banks don't respond. So we think about what we would do in that type of scenario. And then we think about what we do in a soft landing scenario, where actually, we don't go through a recession and rates decline. We think through every single one of these, and we have a plan for each one. I also think this is a really critical thing that I try to do even in my own home. If this is what happens this year, this is our plan. If this is what happens, this is our plan. A plan A, B, and C, and understanding what the probabilities are around them. And then there are some other elements that I think are important takeaways. And I'm going to encourage all of you to do these when you listen to financial professionals, especially in financial media. If you're on Twitter or you watch, I'm on all of them. I do CNBC, Bloomberg, Fox News, Yahoo Finance, TD Ameritrade. I've done them all, and everybody has their own styles. But here's what I would encourage you to do. And if you have the chance to speak with people in economics, the first is to really think in terms of scenarios, not point forecasts. Any financial professional that's on television is lying to you if they say they only have one view and no other one. Every single one has thought through what could happen and has an assigned probability in their mind of alternative scenarios. So you should too. The second is to take a moment and think about what correlations or relationships existed in the past. Are they still relevant or are they not? I think some of these are very true. If someone uses their job, they're less likely to spend money. If interest rates have risen significantly, housing is going to slow. These are very true relationships that will hold, but not all of them will. And it's worth questioning if this is a recession, should it behave like all recessions have in the past? The last thing I would encourage is that most of us are trying to figure out what these differences in this economy are like. It is creating more volatility in markets. We can measure this. We look at this on the day-to-day, especially in fixed income markets. Volatility is opportunity, especially if you're a long-term thinker. Volatility and market moves gives you entry points and exit points that allow you to take tactical opportunities in your portfolio. And if you're working with WealthWise and Lorene, this is exactly the type of manager who's aware of this development. It's a very positive situation to be in. It's the best of both worlds. A manager that can focus on what is this near-term volatility, how are we going to use that to address for the longer term, while still focusing on long-term outcomes. This is, in my opinion, the best strategy for what lays ahead in the next 6 months, and the best of all worlds. So I hope you found that useful. It's a little bit odd as an economist to tell you to listen less to economists, but with these guidelines, I think that maybe you can get more out of the way you think about the economy. I will pause here and end sharing my screen. I'm happy to take any questions, Lorene, from you or anybody else.
Yeah, thank you so much, Frances. That was fantastic. I know everybody has enjoyed what you said so far, and there might be some questions. So, Carissa, I'm going to ask you to unmute anybody who has a question, and anybody in the audience, if you would raise your hand via the raise hand feature in the Zoom. If you'll look for that feature, then we will see who has a question. What's that, Carissa? Do we have one?
Yes, Andrew.
Okay, great. Andrew, go ahead.
Can you guys hear me okay?
Yes.
Okay, good. And you can't see me, right?
No, we can't.
Okay, good. I'm not worried anything. No, I'm kidding. Okay. So my question is, so I've heard the same thing about interest rates coming down. I've heard everything from they're going to come down by the end of this year to the end of first quarter of next year. And then, all the economists that we've been following kind of say the same thing. It's both. And then recently there's been a group of economists that have said, hey, we think it's actually going to be sooner than later. So curious if you had a more definitive time frame, one. And then secondly, I get this question asked all the time. I'm a mortgage banker, and they go, well, where are we going to land? Are we going to, what kind of rates are we going to be seeing? And again, what I've been told is that we are never going to see the 2s and the 3s. That was an anomaly based on the Great Recession and then COVID. But I was curious what your opinion was in terms of like where do we land? I know it's going to trickle down. It's not going to overnight go into say the mid fours. Again, I've heard mid fours to the mid fives is somewhere we're going to land. But how does that trickle down? What is that going to look like? Like where do we end up at the end of the year? Where do we end up at the end of the first quarter of next year? And how does that look if you're able to sort of pontificate about that?
I can pontificate on anything. No problem there. But actually, we have done some work in here. So our formal forecast is actually that the central banks will start cutting in January of 2024. That is the kind of consensus driven. My expectation is that they might move a little bit earlier than that. But the bar, as we discussed, is quite high. It's probably higher than it has been to begin an easing cycle. We're on the lookout for what we call accidents. So just right now, I don't know why my team is talking right now. They should be having dinner with their family, but everyone seems to be talking about a commercial real estate headline. So a credit events and these types of things could encourage earlier rate cuts. But we made a very significant change to our forecasts. I've been doing these forecasts at the current shop for 8 years. And 4 times a year, we generate when is the central bank going to hike or cut? What is the terminal rate, which is where are we going to be in 5 years from now? And where is the center of gravity going to take us? And for as long as I've worked in the industry, we have always talked about coming back to 2%, 2% Fed funds rate. For the first time, we actually inputted something in our forecast that's different than what we did historically, which is we said that the central banks are going to cut not to what they call easing territory, but they're just going to cut down to what they call neutral, which is probably between 3 to 3.5%. That was generally where we felt they go. That's enough to take a lot of pressure off of the economy, but not necessarily to reignite inflation. And as Lorraine was commenting on, especially in the post-GFC period up until COVID, the emphasis was on trying to get inflation higher. That was the anomaly, trying to get inflation higher. Now, as we move towards supply chain disruptions, deglobalization, and weather events, and conflicts and wars, we're probably going to see that tilt away from we need to consistently push inflation higher towards we need to get inflation back towards 2%. With that said, recessions will still occur and easing will still occur. So we have the Fed cutting back to, I believe, 3% over the course of 2024. That's much more than the market is currently anticipating. That's also why we tend to say, hey, you can get into cash if you want in the short term, but you're going to get none of the good benefits that come from being positioned for fixed income in the next year, which should probably be pretty sizable. You'll get the price return and the income out of that, which is quite nice. So right now, by the January of 2025, the implied rate in the futures market is about 4%. So we actually think that they'll be back down to 3%, probably by mid-2024 or later. So pretty aggressive cuts in that term. So what does that mean for mortgage rates? We tend to generally say, I'm going to pull it up here, my US mortgage 30-year fix. What we tend to say is that there was an anomaly between 2009 to 2019, that period was particularly low. But when we think about rates and where we're headed, we tend to think more about that kind of 2001 to 2008 period. So more around the 5-6 type of environment. Maybe, close to sub 5. What really concerns me, and I would love to hear your views on this, is I'll tell you, so up here in Canada, we only have 5-year mortgages. So everybody must refinance every 5 years. And one of the views is that Canada is going to suffer a much worse recession than the United States because every 5 years, you got to go refinance. You don't have the choice to lock in a low rate for an extended period of time. The American mortgage market is kind of one of its kind in the entire world, which is that we have seen refinances drop to record lows on, I'm sure you're seeing this too, Andrew, and I feel for you on this. And of course, what we look at in the data is that housing activity, so buying and selling, is dropping like a stone. Now, interestingly, housing prices still seem to be relatively contained, and that's because, as you likely know, there's a significant supply issue. So what we see is that new home builds are accelerating as a share of total housing. It used to be that new homes were about 10% of the aggregate stock, but now, because nobody's going to sell, not when you're never going back to sub 2%, what we expect is that the housing market gets somewhat frozen and that new homes actually grow as their share of activity in first-time home buyers. This is pretty intuitive. I'm going to guess, Andrew, you've already seen this.
Yes.
But that is effectively one of the big structural risks to what's happening in the United States right now.
Yeah, we're hoping for some regulation relief for the housing market to thrive. Right now, they're just sort of faltering through because of high regulations and uncertainty. But certainly everybody thinks that that's something that we need to do. One sort of interesting little tidbit is a combination. I spoken to a couple of real estate developers on this concept of, you've got these two things that are happening. You've got these buildings that are becoming more vacant, these office buildings, and then there's been talk about retrofitting them for housing. And so while that's an interesting concept, and I think you will see that with certain buildings that have a better potential of retrofitting. I've talked to some developers that say, well, we're not really hopeful for that because the cost of retrofitting can be more than just a build from the ground up.
Yeah.
And so that was one interesting concept that was thrown out there. So I'm wondering how that is going to settle. But certainly everybody would agree that the only way out of this, hyperinflation with housing is to build more. And the only way we're going to do that is to attract the developers with less regulations and more advantages.
As always, please contact our office if you would like an appointment. We're here for you to talk one-on-one about your own goals and your strategies for your financial future. And I want to thank everybody for joining us. Thank you, Francis. Thank you, Travis, for joining us this evening. So thank you, guys, and we'll see you next time.
Thanks for having us.